Great. So welcome you all once again to today's section. We are going to continue what we did yesterday or the last lecture or the last meeting. So a recap of what we are doing. We are looking at how to design capital reduction scheme. So recap, say designing of capital reduction scheme. Capital reduction scheme. Reduction scheme. Good. We said that we have 6 standard steps. Step 1, 2, 3, 4, 5, 6. Then you are done. All of these team up and give 20 marks. All the 6 steps. Team up and give 20 marks. That is the game. The step 1 is the statement of what? Liquidation. Statement of liquidation. And we looked at it yesterday. So if you look at statement of liquidation yesterday, so today we look at 2 with the maximum loss, determination of maximum loss. So that's where we will take it from today. And from there you share the maximum loss. So share of what? Maximum loss. So that's step 4. You do what you call the resource requirement. Good. Resource requirement. So step 5, then the proposed scheme. Proposed scheme. Then step 6, we call it resultant. Resultant statement of financial position. Just after the scheme has been accepted. So let's go down small. Great. So that is it. So these are the 6 standard steps that we have to go through before we can design a capital reduction scheme. So today, looking at our sample question, we will continue from the step 2 up to the step 6 to finish it up. And then we are done for design of the scheme. However, the examiner can ask any of these steps on its own. It can ask you to explain the position of the key stakeholders in event of liquidation. They are just asking the first step. Second step, they can also ask you to determine the total maximum loss likely to be incurred when the company wants to revive the business. That's a step 2. Then ask you, from the above calculation, is it possible the company to push to liquidation or revive? Then you compare the losses at both ends. Then you are done. Then they can go, if let's assume that the reconstruction is accepted, what will be the next step or the share of maximum loss in that order? We ask you individually, and then we award the 10 solid marks over there. Good. Good. In fact, we can also ask the question at just in one caption, like design the scheme and prepare the financial position after the scheme for the company. So that one need all the steps. In fact, once you are designing the scheme, you need all, but sometimes the examiner can ask them individually. Good. And then that is it. Okay, so let's quickly look at the question that's we are looking. So as a parameter, we are on the determination of maximum loss. What goes in the maximum loss? What goes in the maximum loss? So let's see what goes in the maximum loss. So maximum loss, that's a step 2. So let's determine the maximum loss. So step 2, the maximum loss. I'll do that one here. It's a very large calculation, so let me do it somewhere here. Step 2, determination of the maximum loss. So we call it determination of maximum loss. Now, if you want to revitalize organization, we are failing, we are struggling. What will be the total, the highest loss that we have to claim, both from the books? Some of the losses that have not been captured, still have to claim them. Because we are failing, not all losses we capture them. Other than that, where's the position? Not all losses. Some of them we plead with them that please, your loss will not be captured on the balance sheet. So pardon us. In the event of reviving or reconstructing, all these losses must be cleaned from the books. So that after the reconstruction, we know that yes, we're on the clean ground. Now we can start our business again. Great. So here, all what you have to do is this. Don't worry at all. First, write all the assets here. The losses, we have it from three folds. One, losses in the book, coming from the books. So losses from the books, number one is the assets. Number two is the income surplus, which is the same as the retained earnings. Great. Then that is it. Then we have other losses. Other. Other ones, they're in the footnote. They're in the footnote. So take notes that number one, losses coming from the book. That's losses on the financial statement. It's in the financial statement for you. It has been captured. Some of the losses have not been captured. That's a B. Where do you see them? Footnote. Number one is the preference dividend in arrears. So preference dividend in arrears. And then two, interest on debenture in arrears. Sometimes the interest on debenture in arrears. So these are the losses that we have to claim from the books. Then number three, reconstruction expenses. That is it, reconstruction expenses. So number three is reconstruction expenses. Reconstruction expenses. So these are the losses that we have to claim. That's all, we are done. The first ones are in the books, so you have to clean them. They are in a financial position. The next one is in the footnotes. You are done. So we start with all the assets. All the assets. Then we go to income statement, preference dividend arrears, interest on debenture, reconstruction expenses. It is not compulsory for you to have all this in one question. No. Take notes. Especially this one.
Interest on debentures is the one in arrears.
Yes, the one in arrears. Interest on debenture in arrears. These losses are not in a financial position. You can't see them in the balance sheet. These losses, they are not on the balance sheet. These losses are not on the balance sheet. They have not been captured. Good. So basically, that is it. Okay. Then let's just assemble them here, and then we are done. So assets. Let's go to asset first. Then we are done. So let me go up small. So good. So the format to be, we'll start with the asset first. So to be like this, nice table. Now when you list the assets, there are two values that we need. We need a book value or the current amount. Did I write book value here or current amount, CA? Then you need a going concern value. The going concern value. So I will explain that one too. Going concern value. Then you need a maximum loss. So this is the maximum loss. So that is it. So that's how the headings will be like. That is how the headings will be like. Then we are done. So first, to get it straightforward, go to the financial position, list all the assets, no demarcation. List all the assets here, no demarcation, except cash, except what? Except cash or bank balance. All the assets, list all the assets except cash or bank balance. Why? Because if you are reconstructing your business and you have 1,000 Ghana there, would they say because you are feeling that 1,000 Ghana must be reduced to 800? No, it's not 1,000 Ghana. So there's no loss coming from cash and bank balances. So you are not losing anything. So except those two items. So let's go to the question and then list all of them. So let's go to the question. If you have your own there, can be with us as we are moving there. And let's go and pick them. So we are solving Asempa Limited. Asempa Limited. Why are you? Asempa, why are you? Why are you? Why are you? Asempa, where are you? This Kumasi Shoe Factory. Good. So here it is Asempa. To list all the assets, freehold property, plant and machinery, deferred development expenditure, inventories, account receivable. So there are only 1, 2, 3, 4, 5 assets. So you list them. Good. Here you are free to copy their figures, but the figures must be under the book value. So if you start with the very first assets, then you write the book value here, copy all the associated values to here, then you relax, then you come back. Okay, so let's see. I bet we can select these values. So help me select the values, eh? Good. So first one is freehold property. So that's 3920, right? The book values. So freehold property. All right, here freehold property. Freehold property is 3920. Agreed. Then I'll move on to the next asset on the list. Plant, machinery, and what? Motor vehicle. So plant, machine, and motor vehicle. That one is, so that one is 1,050. Or if you like, you can list the names first. You can list the names first. 1,050. Then we have deferred development expenditure. We have account receivable. We have inventory. Okay, so I've listed them here. Account receivable and inventory. All the assets as they've put in there. Okay, your inventory came first, right? You need to worry. So the deferred development expenditure will be 3490. 3490. And inventory is 2020. Accounts receivable is for 760. Great. So here is 3490. Here's 760. Here's 2020. But anyhow you arrange them, this one's supposed to be in here. So avoid trouble. Do not do anything, but inventory must be in. Inventories and account receivable. Inventory has to be 2020. This has to be 760. That is it. So that's perfect. Great. So now first thing you have to do is to just record the all assets on the face of the financial position, all assets. Don't touch any figure in the footnote, all assets. Then record their values here first and relax for a while and come back again, at least 20 seconds. Now you're going to pick the going concern values. Now the going concern value is the reverse or the inverse of the liquidated values. Good. So you write it. Number one on the list, going concern value. First, look for the fair value, which is the same as the revalued amount. Number one, fair value or revalued amount. Good. Number two, value in use. Number three, value in use. Number three, the recoverable amount. Number four, NRV. Then number five, if all of these are not there, you have to use what you call the for sale value. The for sale people. For sale value, breakup value, or liquidated value, or disposal value. That is it. But please and please again, if there's fair value there, and come and select the
The second one is what? Number two.
number two is value in use. Value in use. Value in use. That is the second one, value in use. The next one is recoverable amount. Next one is recoverable amount. Recoverable amount, NRV, for sale value, and then that is it. Recoverable amount. The recoverable amount. No. So this is the order. It's a direct inverse of the liquidation. For liquidation, you select the for sale value first. If it's not the NRV, followed by the recoverable amount, value in use. These ones, they're in the same shoe. Value in use, revalued amount, or fair value. That is it. So all these figures are in a footnote. None of them is on the financial position. If it's happened to you on the financial position to be a referral game, you go to the footnote and refer it out, okay, just take the position in the financial position. Great. So basically that is it. You are in the footnote. So check the footnote for these figures. This is the financial position figures. All the assets. So that is it. So now let's go to the footnote to pick their respective fair values or the revalued amount. So let's go. Let's move together. Let's move together. So straight to the footnote.
The breakup. The next is still
Yes, please. Good. So in the footnotes, you have been given the following additional information. The company's freehold property was acquired on 31st January 2010. The directors believe that the net disposal value of the freehold property at 31st of December 2011 will be what? 4 million. Okay, so they have given us only the liquidated value. If there's no fair value, if there's no fair value, no value in use, then we have no option to use what? The liquidated value. That's the last option available. So make sure that you've gone through the question and there's no fair value somewhere. There's no fair value where? Somewhere. Great. Some of the questions you'll be given fair value NRV and liquidated values. If you check the first question that we solved, let's go there. Yes, I'm there now. So there's fair value here, there's NRV, and there's for sale value. 3 has been given to you. Which of them are you going to use? Use the fair value. Good. So in that order. Now let's continue our question. Great. So it means that over here, since we don't have fair value, number 2, we don't have the value in use. Number 3, we don't have the recoverable amount. Number 4, we don't have the NRV. But finally, we have what? The net disposal value. So we can pick that one as the going concern value. That is all. But take notes. In some questions, not like that. Okay. So that's fine. So let's go in and then key that one in it, and then we are done. So take notes. So property will be what? Property will be 4 million. But there's no value available. So that's why we are selecting what? The liquidated value as what? Going concern values. It's in order. Please, let's follow the order. That is all. Some of the question, all the items, they'll give like 3. Select the very first one on top, then you are done. Great. So let's see. Now let's continue the game. Now, note 2, it is estimated that the breakup value for plant, machinery, motor vehicles at 31st December 2011 will be 900,000. Perfect. So 900,000. So let's see. So here will be 900. Then I'll go to the next asset on the list. It said that the deferred development expenditure has been patented. It is estimated that if the company is liquidated, it could be sold for 2 million. And since we don't have the fair value, usually in the same footnote, they'll give you the fair value and the liquidated value. Yeah, the same footnote. Or they will do the grouping somewhere and inform you. Good. Yes. So as a result of that, they've given us only one figure. That's why we're using it. Because we have no option than to use that one alone. Yes. So the fair development expenditure will be 2 million. That will be 2,000. So I'll go and put it in. 2,000. I'll go to inventory. Inventory. Inventory 2. It said that the inventories are estimated to realize their carrying amount in event of liquidation. So they're expected to realize their carrying value. So the carrying value is the one in the statement of the financial position, which is the 2020. Good. And then is this value, so 2020. Then receivable. Let's go to the receivable. So if you do the arrangement very well, there's not to flow like that for you. But if you, yes, most often, except one of the question, iodine. Iodine Limited, we didn't move that way. That one was skirt and browse. Yes. Iodine Limited was skirt and browse. That one, we scattered them inside. It wasn't moving in that order. We scattered them. Iodine. Yes. That was a plan game. Mhm. Okay, so note 5. One of the major customers of the company has been declared bankrupt. Asempa Limited is likely to lose 100,000 of the amount due from the customer. So if we have a receivable of 760 and it's likely for us to lose 100, oh, then the going concern must be 660. Now when you're done like this, then you pick your calculator. Don't worry yourself. This figure minus this figure, put the answer in here. You are done. If it's negative, put it in brackets. If it's positive, leave it like that. Negative means gain, positive means loss. So let's see. So freehold property, the book value is 3920, but the going concern value is 4,000. So this figure minus this, and that will give us 80, right? So that will be negative. Negative means a gain, not a loss. Here, all the losses are in positive. Why is it a gain? I have an asset, the book value is 3,920, but the going concern value or the fair value is 4,000, which has increased. So it's a plus to us, like revaluation gain. This is the current amount versus the revalued amount. IAS was 16. It's calling you here too. IAS 16. So if this is the revalued amount and this is the current amount, so there's a gain of what? 80. And the gain is in brackets over here. Let's go to plant and machinery. The current amount is 50, but the fair value is 900. So we are losing 150. That will be positive. So that one, this minus this, put the answer here. Don't even worry yourself. If the answer is positive, leave it positive. If the answer is negative, put in brackets. That's all. This minus this. 3,490 minus 2,000.
1490.
So 1490. 2020 dash. Here's 100, right? Okay. So when they're done, these are the losses coming from where? Assets. All assets. And we said that the losses that they have to claim from their books or from the company is not only coming from assets. So let's add this. So we know the losses coming from where? Assets, then we continue the game.
1600.
So 1,660. So these are the losses coming from where? Assets. Their asset alone is giving us loss because one of the steps stated that in reconstruction, the asset must be what? Revalued. And if you do the revaluation, then you're going to have a gain or loss. So in all, you can loss of what? 1,660 as the losses coming from the asset. Then you continue the game.
So can you also give
Is that
what the loss on the assets are?
the
Loss on the asset.
so this is the total loss from where? Assets. So total loss from the assets. But you don't need to name it though. I'm naming it. Then we said that you go to the income surplus, right? Go to the equity. There's the equity on the statement of the financial position. All the item over there, except the stated capital, must be cancelled. All the items over there must be cancelled. Okay, so let's see. So let's go to the financial position and pick all the items except what? Go to the equity section. If you go to the equity section, we have stated capital there, 880. No, we don't pick that one. Then we pick what? The income surplus.
I need a clarity. So when you go to the equity section, assuming you have capital surplus
Good.
or revaluation surplus, and then so that's the capital surplus, revaluation, those other surpluses, we clean all of them and leave only the stated capital.
Great. So all the reserves must be released or cancelled. Good. And sometimes a good examiner will inform you that the capital surplus must be cancelled. When they inform you, you have to cancel it. If they don't inform you, you have to also cancel it, even if it's positive. Yes, then you cancel the capital surplus. Good. I think we look at a question where there's capital surplus in it and how do you cancel it. Most often it's the income surplus that you put in. Yes, in the reserve. Okay, so that is it. So this is the loss coming from where? coming from the financial position. These are loss coming from the financial position. Great. So the income surplus is what? 7340. That's the loss coming from income surplus. It is in bracket. That suggests that the company is what? Struggling, making consistent losses. So it's already negative. So when you pick it, just add it. Add it to its counterpart. This is the loss coming from where? Loss is coming from good. The assets. So add it to its counterpart. Yes, you made the story. The Mokia story, right? Good. Now let's see. So we write the income surplus. And the figure is 7360, right?
734.
Perfect. Now let's see. What are the other losses? So these losses are from the book. From the book. We are down the losses from the book. Or from the balance sheet. Left the losses from where? Other. Footnotes. That's all. So check the footnote. What are the other losses there? If you can find some of them, you are done. So let's go to the footnotes. And the losses in the footnotes are the one that we listed. There are 3 in number. Only 2 or 1 must be there. Number 1, reconstruction cost. Preferred dividend in arrears. Number 2, interest on debenture in arrears. That is all. So let's go to the footnotes and look for them. So reorganization cost of the company is estimated to be what? 30,000, right? So that's 30,000 reorganization cost. So other. So right here, reorganization cost. Please, this section should not become O. These sections are not part of the solution. O. It shouldn't come O. So reorganization expenses or cost, which is 30. I'll put it in. We are adding to it counterpart. Okay, exactly. Then we move on to the next one. Do you have preference dividend in arrears? We check the last footnotes or last but one in 2 years in arrears. And we've already calculated this from the step 1. So we calculated this from the step 1. So let's pick it from there. Good. So you pick the 18% on 3.15 million, and then you multiply by 2 years because that's the preference dividend. It's in arrears for how many years? 2. And then you are done. So take note of that. Okay. Then we had 1 So preference dividend in arrears. Then we had 1134, right? Right, it's not coming. 1134. One, 1134. So now you put all of them together, you get a total maximum loss. So total maximum loss. Total maximum loss. Let's put all of them together to get a total maximum loss. Okay. So total maximum loss is 164. Oh, so 10,164. Perfect. 10,164. So from here, should the company liquidate or they should reorganize? Should the company liquidate or they should reorganize?
So they should reorganize.
Okay.
But the loss per liquidation is one.
Perfect. So to answer this question, we have to bring the loss per liquidation, the total loss per liquidation, and compare it to the loss per what? The reconstruction. If they have to reconstruct, the total loss that they have to claim is 10,164. They have to claim 10,164 from their books. That's the total loss that they have to claim from the books. So from the previous lecture, what's the maximum loss per liquidation? We have 10,000.
176.
Good. So 10,176, which is more than the loss per the reconstruction. So hence, they should go ahead with what? The reconstruction. Uh-huh. If the examiner asks you to design a scheme, that one, you don't care whether the loss per reconstruction is cheaper or not. So you have to design a scheme for them. So that is it. Okay, so from here we go to the step 3. Step 1, 2, and 3, you have to score everything there. Step 1, 2, and 3, you have to score everything there. So step 1, 2, and 3, you have to score everything there. Let's go to step 3. Now that we know the maximum loss, then we have to now share what? The maximum loss. So the step 3 will be share of maximum loss. If you are going to continue with the reconstruction, then the next stage is to share the maximum loss. If you have to end here, because sometimes the liquidation might be cheaper than the reconstruction, then you end here and go and liquidate the company. Good. So that is it. Okay, so any question? Any question? Great. So let's go to step 3. Share of the maximum loss. We have to share this maximum loss to the key stakeholders. So share of maximum loss to the key stakeholders. That's step 3. Share of maximum loss to the key stakeholders. Share of maximum loss to the key stakeholders. Share of maximum loss to the key stakeholders. Great. So I think we do that one here. Share of maximum loss to the key stakeholders. Great. So let's see. So share, that's step 3. Share of maximum loss. Maximum loss. Now, the table look like this. We first of all have to start with the key stakeholders. And these key stakeholders, you know them already. It's coming from the step 1. Good. So here is the key stakeholders. Key stakeholders. Then you bring the loss per liquidation first. The position that we did, then is the maximum loss or share of maximum loss. Share of maximum loss. So let's list the key stakeholders here first. Honoring shareholders. Second, preference shareholders. Third, the 20% debenture holders. All these can be found from where? The step 1. Position of the key stakeholders. Good. Then the next one will be the account payable, then accruals, then what again? And there's bank overdrafts. Then we have preference dividend in arrears. So these are the key stakeholders. So to avoid popomiasis, let me move my lines here. To avoid popomiasis, let me start. Is it? It's true. Okay. So this will be the okay. There's the schedule coming here, right? So I hope you've seen the other section. Good. So key stakeholders. The key stakeholders. Then we are done. So let's start. This is a loss per liquidation. So from the step one, how much each of them, how much are they losing? So ordinary shareholders, they are losing everything, right? Which is 5-1.
5730.
Good. Preference shareholders, they are losing 3-1-5-0. This is coming from loss per liquidation. The first working that we did, they are positioned in event of liquidation. We will explain why we are bringing this. Then the venture holders, they are not losing anything, eh? Accounts payable is 136. 136 accruals, bank overdraft, then preference dividend in arrears 1134. Okay. So this is the loss per what? Liquidation. This is the loss per liquidation. Now, then what you do is this. You first of all record the total here. Total for this, you have 10,176. Then the maximum loss coming from step 2, we had 10,164. Agreed. Good. So this is the maximum loss that we have to share among these key stakeholders. But please and please again, the reason why we place these ones here is this. We have to place these ones here as a benchmark so that we won't go and then annoy some of the key stakeholders. So the principle is this: share them based on your discretionary view or based on your own interest. You can try to give anybody amount, we don't care. But what matters is make sure that the basis for sharing must depend on the loss per liquidation. So number one, under no circumstances someone should lose more than his position in case of what? Liquidation. So that's why we bring it here as a what? As a benchmark. You based on this figure to share the loss. It is discretionary. Any one that you select is correct, but make sure that it follow the principle. So first thing I'll do, I'm going to share this. Bank overdraft, they are not losing anything. So for my scheme 2, they should not lose anything. All the dash people have to repeat it. Why? Even if I put 2 Ghana cedi here, they will not understand. They will tell me that upon liquidation, they are not losing anything. So my scheme 2, they should not lose anything. Other than that, they will force for liquidation. So in essence, because it's discretionary, if you come and put any figure here, you are wrong. Because that people will not agree. Because it's not owing upon what? Upon liquidation. But upon your scheme, he says you lose 2 cedi, will not agree. That is it. So you must be dashed. That's the first thing you have to do. Then look through which are the losses that we can clear. This preferred dividend, you have to clear it too. We are struggling. Why should you owe you dividend? So 1134. First thing that I'll clear from the road. Then that is it. Then the rest you can share by public pro rata basis, or you can just look at their faces and put them. So okay, then these people 5,730, right? And now let's
Yes.
573, right? So I'll let them bear 5,700. Or in fact, they should lose everything. They should lose everything. These people too, but they should also lose everything. Discretional. Obviously, it shouldn't be more than what they'll lose here. Put all the two together. What do you get? If it's not equal to this, then there's still share it for these two people. They should bear the remaining loss. Then we are done. Whatever remains after I've shared, so I'll add this 1, 2, 3 together. Find the difference from the balance. This one, whatever remains, I'll give to the remaining people.
That is 150.
So left with 150, right? Good. So 150. So this 150, I have to share it between these two people. So how do I share it? Okay, 150. You can take 125. This guy will take 25. But you see, like it's a bit unfair to this people, this person, right? Good. So this guy's one must increase. Or you can share it on pro rata basis. So you can share it on pro rata basis. So that means the 150 must be shared between two people. One person have 136 as the account payable. Accruals to have what? 26. So putting all together, I get 152. So I can share it on pro rata basis.
162.
I'll pick good. I'll pick 136 divided by 162 times 150. Whatever I'll get, I'll give it to who? The accounts payable.
24.
Good. So accounts payable will get
24.
no, they should get more than 24.
Wait, you are doing the 160.
So accrual is 24, right? Then account payable will be
126.
126. I've said it on pro rata basis. It's a bit fair. Yes, it's fair. Then you are done. In fact, even if we said that they should lose, let's say 28, they'll not agree because upon liquidation, they're only losing what? 26. But if we ask them to lose more than their position, they will not agree. That's why we bring this section as what? As a guide. As a guide or as a benchmark so that we won't go in and annoy some of the stakeholders. Yes. So take note of that. Then we are done. So here will be 26 and here too will be 24. We are done with the share of maximum loss. We are going to the next step. Step 4. Step 4 is what? The resource required or the resources requirement. Here, you don't need to worry yourself too much. Don't need to worry yourself too much about the resources requirement. Don't need to worry yourself about the resource requirements. The steps are 6. Make sure that you get like 5 of them correct. This one should be okay. But let's do it for teaching purposes. Step 4, resources requirement. So step 4, resources requirements. Step 4, resources requirements. Then we are done. Resources requirements. Now with the resource requirements, now here we have to get some money and make some payments. That is all. Have to get some money and make some payments. So you list 2 items here, payments and the receipt, or the receipts and what? Payments. Any of them. So normally we start with the payments. Right here, payments, because you have to make some payment, and then leave enough space and write here receipt. Or you can finish all the payment first, then the remainder will be the receipt. So like this, nicely, like this. So first, payment. So what will be the first item that you have to pay? You go to the footnote. Is there any person who or any of the key stakeholders who have raised the alarm that we should pay his money? Like any of the debt holders have requested his money to be paid. You have to go and make that payment first. But we have a compulsory payment and optional payment. Compulsory payment, number one on the list. The reconstruction expenses, you have to pay them. So reconstruction expenses. That's the first item that we have to pay. The reconstruction expenses you have to pay. So what will be the reconstruction expenses here? That's the 30. Good. Is there any other payment? And we have the discretionary payment. Go to the current liability. At least pay all of them and leave one. Current liabilities. At least pay all of them, or pay some, leave some. So you go to the current liabilities. So in all cases, leave just one current liabilities. Now, some of the current liabilities, they have not given indication for their payment. Look at the one that they are not owing. So let's go to our list. The current liabilities are we have accounts payable. Per our liquidation, they are losing 126. Accruals, they are also losing what? 24. Bank overdraft, are they losing? They are not losing anything, so we shouldn't pay them. They are not losing, so we shouldn't pay them. Because sometimes the one that is losing, if you don't pay the remaining balance, probably might get angry or might not be happy with it. So once they are losing, you have to pay them off. Then they have to go. So that is it. So so yes,
And
please.
then we are not sharing any loss to them.
Good. Now we have to pay people that they are losing so much upon our reconstruction, and leave those that are not owing, they are not losing. So if you check these three people, the current liabilities are three. Number one on the list, bank overdraft, they are not losing anything. Number two, accruals, they are losing 24. Number three, accounts payable, they are losing 126. So if we have to pay some people, it's the person that who is losing plenty that we have to pay. So I'll pay these two guys and leave what? The bank overdraft unpaid. Why? Because the bank overdraft, they are not losing. In fact, they've even extended the credit for us. If you go to one of the notes, it said that the bank overdraft credit has been like extended. The limit is 4,000 or 4 million. Then we have, so let's go to the footnotes for the bank overdraft. Now it's saying that the bank overdraft limit is 4 million. We have not exceeded the limit. We have only 2,100, right? So we still have about 2,100. We still have about 1,009 to in addition, right? Good. So you go for the 1,009 in addition. So that is it. Yeah, they've not requested for their money. Good. So we are not going to pay that of the bank overdraft because we've not exceeded our limit. If we have probably exceeded our limit, then we have to pay part to come to the normal level. Good. But here we have more funds bring in. So these are the three current liabilities. These are the three current liabilities. Bank overdraft is 2,100. So you have to pay.
Follow the resources and then when you are looking for the payment, you look out for the current liabilities.
Yes,
And then the reconstruction costs.
perfect. Now with the payment, first we have the compulsory. That's the reconstruction expense must be paid first. Second, then the discretionary payments, and then we move on. So let's pay the accounts payable and then the accruals. So accounts payable. Account payable, how much should you pay them? What's their position? What's the total amount that we owe them? Account payable. Total amount that we owe them.
3,200.
So 3,200. So should you pay all of them? But we are reducing their value by what? 126, right? So you pay them the remaining balance because their position is 3,200 and then they are losing 126 upon your scheme. They are losing what? 126. So therefore, manage the whatever they are losing. Remaining balance will be paid immediately. So that is it. So 3,200 less the 126. Whatever remains, we are giving it to them.
3,774.
So 3,074. Perfect. Then let's go to the accruals. Let's also pay them. Accruals. Now these two, it is not compulsory for you to pay them. It is discretionary. But the humble advice is that pay all the current liability, leave just one. For safety purposes, leave just one. Pay all current liabilities and leave what? Just one. Pay all current liability. Accruals to what's their value? It will be 600 minus how much they are losing. They are losing 24 here. So how much should you pay them?
576.
So less 24. So that would be 576. Perfect. So this is how much we are paying them. Then we continue the game. Now let me two items. Let me two items. Let me two items. What are the two items? First, we have what you call the working capital requirement. That is the heartbeat. That section is a bit slippery, but we took our time to go through that section very well. Then we see. So you put working capital requirement here. Now this working capital requirement, you have to get its calculation from the footnotes. Working capital requirements. We're going to do workings on that. So maybe workings number 1. Then from there, realize that at the inception of the question, the examiner said the company had consistent losses, and one of the reasons was that they have aging plants. So as soon as you see that the examiner mentioned something like that, then discretionary, let them buy a plant, put it inside. Acquisition of the plant. How do you get that value? Wait, get the money received. Get the receipt first. Whatever be the difference, let them use it to pay or buy the plant. So yeah, acquisition of plants. They should buy plant because some of their plants or part of their plants are too old, so they need to be replaced. So plants, I'll put it here. Now when they're done, you sum all up. These two. Now the issue is this. If you think you cannot work on this, don't even worry yourself. Put any figure there. Like, you can put your date of birth there. Good. I'll put 1935 there. So that's the 9 date that I like. I'll put 1935. Plant. Put any figure there. Maybe 2000. They should go and buy new plant. 2000. Discretionary. This one is discretionary. Please. This one is not discretionary. You have to go and work on it. By an event where you cannot work on it. Then you go to the receipts. So you sum them up, look for people to bill them. Who will pay this money? Because we need money to settle all this. Who will pay all this money? But this, I'll go and work it out. We'll work this one out and work this one also out for you. Over here, for teaching purposes, work everything out. But for examination purpose, in exams, where time is going, don't want to work it out, just put your date of birth there, you are done. It's going to mark it for you.
Without even working.
Yes.
Then better we don't work.
No. But you lose a text over there. But this one will compensate you the plant. Then you go to the receipts. Here, all money that they are going to receive, place them here. All money that they are going to what? Receive, place them there. All money that they are going to receive, place them there. Okay. So let's go and then pick the receipt. Sometimes they will tell you that some of the people or some of the key stakeholders, they are willing to contribute more to the company. So let's go. If there's something like that, where would they get money from to pay all these items that we've listed there? Number one on the list, check the shareholders. How much can they give us? It's in the footnote. They told us that according to note 8, right? The ordinary shareholders are prepared to introduce additional capital of what? 3 million. If they consider the proposed scheme to be what? Satisfactory. So it means that you have up to 0. From 0 to what? 3 million. Coming from where? The ordinary shareholders. So first, we write the first person on the list, shareholders. They should bring us shareholders. Which shareholders? The ordinary shareholders. The ordinary shareholders. It should be the ordinary shareholders. We have the preference shareholders here. The ordinary shareholders. Good. How much? They have to give us what? 3 million, right? So ordinary shareholders have to give us 3 million. So that would be 3,000. Who again have to give us money? Let's go to the footnotes. A lot of people should give us money. A lot of people should give us money so that we can use it. It says something that we have to sell one of the items. The deferred development expenditure has been patented. It is estimated that if the company is liquidated, it could be sold for 2,000. Any of our assets which is too old, we have to sell them off. So this expenditure has been patented, so it must be what? Disposed of for what? 2 million. So you are going to sell what? The deferred development expenditure for 2 million. So that one we will receive money, right? When we sell it.
But the condition is that they say if it's liquidated, but it's under reorganization.
Yes, but we are selecting the patented section. That has been patented, meaning part of the value has been lost. So we have just lost the value, but we can only realize 2 million from it. So let's sell it so that if you keep it in our books, but you lose everything. So it's better now we are doing the cleanup. Those that they are like life and death, let's clear them from the book so that we can know the active ones. Good. So if there's any asset in which the stand of the asset is not too sure, let's sell those assets off so I can get the good ones in. Yes, because they are part of our failure. So let's clear them off. Good. So you have to sell. So you're looking for the money. You're going to sell this deferred development expenditure. So deferred development expenditure 2,000. Where again can we get money?
They hold you.
Yes, the bank overdraft. We can go and then Take the remaining balance. So bank overdraft. You can go there and then pick the remaining balance. Where is it? The limit.
The limit is 4 million.
Okay.
The note before the ordinary.
So good. So that's the note 9. The bank overdraft limit is 4 million. Currently, we have only what? 2,100. So we still have about 1,009. Additional 1,009, right? So let's go in for the additional 1,009. We need money. Yes. So we go in for additional bank overdraft. So 1,009. Tell us how you got 1,009. You pick the 4,000 minus the current value, which is what? The
2,100.
yes, 2,100. Perfect. So 2,000. The 4,000 minus the 2,100. That gives us 1,009. What about the preference shareholders? Now take note. If you don't ask the preference shareholders to bring something, that means you are sacking them, which is unfair. They've lost all. At least give them chance to bring something so that in the new business, their names should be in there. Because they've lost everything. We said they should lose everything. So let them bring something. At least it should bring, let's say, 1 million or 2 million, right? Yes. Preference shareholders, they should bring some money. So how much should they bring? Preference shareholders, discretionary. These ones are discretionary. So you can select any amount, let them bring, then you are done. So you can select any amount, let the preference shareholders bring, then you put them together. So let us know the preference shareholders, they are bringing, let's say, 2,000 or 1,000, but just that their own should not be more than the ordinary shareholders. Yes. So they should bring 2,000, right? Okay, so preference shareholders, they are bringing 2,000. They are bringing 2,000. Preference shareholders, they are bringing 2,000. Perfect. It is discretionary. These ones are discretionary. Yes. So preference shareholders, they should bring something. Other than that, it's not being fair to them. Preference shareholders, they are bringing 2,000. Now put all of them together. Put all of them together. You put all of them together. Then now elevate one item. We have to use this money to make all these payments. You have to use this money to make all these payments. So 3,000, 2,000, 5,000 plus 2,000, 7,000. So 8,900. So that's the total amount that we are going to receive. And that's what we are going to use to pay this. Now this guy is a balancing figure. But this one we can work for it. So let's go and work for the working capital requirement. So I want to work for that one. But I hope yes. Exactly. In examination, you just find any figure they put it in 1995 here, you did. Yes, this total must be the same. It must be 8,900. So left with these two figures. Exactly. Then you put them there to balance nicely. Just that you get it all wrong. Go.
Because it's working.
Yes, but you didn't show any working here for us. Get it wrong. When happening that way, create additional assets. They should buy more assets. So that at least don't want those discretionary one will compensate this loss for you. But for purpose of the issue, let's do the workings for the working capital requirements. Yes. The workings one. Working capital requirement. How do you work it out? Good. Now I'll clean just this section and do it here. I just want to clean here and then do it there. Perfect. I want to clean just this section and then I'll do it here. So look at how you're going to do it. First, How do you find working capital requirements? Okay, it's true. Okay, so this will be the total.
So this one, how to do the relation?
Good. Let's see. Sometimes they have to give us the working capital ratio. They have to give us the working capital ratio so that we use the working capital ratio. So let's go to the question. You have what you call the current and then the quick ratio. They have to give us one of them. Mostly it's the current ratio that we give out. So take notes. They will ask for specified current ratio. After the reconstruction, the new business, the revived business, they need a certain working capital requirement, a certain current asset, certain liability. Good. Now, if you put any figure here, the danger is that when you finish, we have to calculate your current ratio. If you don't get what we have asked you, you are wrong. Uh-huh. So take notes of that. So let's go to the financial position and go and then check whether they have or they've given us that of the ratio. If they don't give you the ratio, there are two methods. In this question, the ratio wasn't given. The ratio wasn't given to us. No ratio, unlike the other questions. If you go to probably the next question, like Ebusia Limited, let's go to Ebusia. If you go to Ebusia, they have to give us this Ebusia Limited. They have to give us the ratio. They'll ask the ratio. So the company will require the ratio of account receivable and cash to current liability of what? 0.80:1. That's the ratio that they are asking for. Good. So have you seen here? This is what you call the quick ratio. Account receivable and cash. They don't include what? The inventory. So that's the quick ratio. So either you are going to move you between the current ratio or the quick ratio. But most often it's the current ratio that will move you through. Good. So here let's select our own. So let's go back to the Asempa question. Now when we go back to Asempa question, they didn't tell us which ratio we should use. Now if they don't tell you, you have two options. The straightforward one, the best one, then that's all. Please, if you go like Asempa Limited, there's no ratio, there's no working capital requirement. You have to create one. That one is so interesting. You have two options. Any of them is correct. One, you have to guess your own working capital requirement. Guess your own working capital requirement. So guess your own. That one, you guess the amount, monetary version. Number two, you guess your own current ratio. Your own current ratio. The one on the surface side is the first method. The method one, guess any amount you like. Any amount. So look at this range. I'll guess any amount here. So I'll guess, let's say, working capital requirement must be 3,000. That's if they don't give it to you in the question. Guess your own. It's a compulsory. It must be in your payments. So everyone, it must be among your payments. So you guess any figure at all. That's all. Then the second one is the challenging one. Guess the ratio. Maybe current ratio must be 2:1. So that will be your guess, 2:1. Or you can guess a lump sum of money. To be on server side, please guess any figure. Put it there. 3,000. That's all. Don't go and guess 2:1. If they don't ask you 2:1, even if they're asking 2:1, we are dodging. And now that they've not asked that, you are bringing yourself low. So that one, yes. But for teaching purposes, I will guess 2:1 here. Whatever you guess will not have impact. It will balance nicely for you. Whatever you guess. If you do it well, it must balance. Does not have impact on it. So here for teaching purposes, I can get 3,000. If I get 3,000, I just have to strike average and then find the difference for the plants. I'm done. Here, if you guess it, we mark it for you. Why? Because we didn't tell you the ratio. So you have the chance to choose whether you want to use ratio or our amount. You are free to go. Great. So that is it. But here, for teaching purposes, I want to guess 2:1. Yes, current ratio of what? 2:1. Current ratio, not quick ratio. Okay. So that is it. So current ratio of 2:1. Great. So how do you get it if you have guessed 2:1? By next time, please don't guess 2:1. Just guess the figure. Find the difference. Put the plan there. You are done. Okay. So basically, that is it. So let's see how best we can look at this. First, write the current assets. First of all, write the current assets. Let me stop declining. So first, write the current assets here. Or you can start with your current liability. Current assets. In a new business, what will be the current assets? Inventory and account receivable, right? There's no cash. You don't have cash here. So inventory and account receivable. Leave here. This is the working capital requirement. It's a balancing figure. Yes, it's a balancing figure. Please, among all the 6 steps, this is the terrible step among all the 6. So as you are seeing stars, you can, like, out of the 6, if you can do 5 perfectly, why not? Go ahead. Do the 5 perfectly. And here use the averages and then your own discretionary figures, put them in plenty. Then you add up. So working capital requirements, it's a balancing figure. In a new business, inventory figure will be what? You took the going concern values. So go to the maximum loss and go to the going concern value. Inventory, it was 2020, right? Receivable, it was 660. Agreed. Then this is the balancing figure. Let me put X there. If I add all, it will be equal to total current assets. Then I'll come to current liability. Current liability. Now, let me explain the reason why you have to pay all the current liability and leave just one. If you leave a lot of current liability, it will create an issue for you. You have to list all of them here. But here in a new business, the only current liability is what? Overdraft, bank overdraft. Only one. Leave just one. You have to list all of them here. So here's the bank overdrafts. That's the only current liability left in a new business. And that one, the figure will be what? You want to use the 4 million. The bank overdraft to be 4 million, right? In a new business. It is what? 4 million. Now, this 4 million, because we have requested for additional 1,009. So in a new business to be what? 4 million. The bank overdraft already we have 2,100. Among the receipts, we have requested for this one. We have requested for additional 1,009. So that's moved from where? The 2,001 that we have plus the 1,009 to what? 4,000, the limits. Agreed. So in a new business, our bank overdraft will no longer be 2,100. It will be 4,000. Why 4,000? Already we have 2,100. And we ask them to give us more to get up to the limit. The limit is 4,000. So we requested for additional 1,009 plus what we have there. Originally we have 2,100 plus what we requested for 1,900, making 4,000. So if you want to use all of them, it's allowed. Put the 4,000 here. Alternative, discretionary. You can also tell them that This 4,000 is too much, right? They should convert some to be what? Debenture or loan note or long-term liability. You having a current liability or a bank balance of 4,000 is too much because your 20% debenture loan is 3,800. If you can work with it, it will balance nicely. You can maintain it like this and work with it to still balance for you.
So what if you also look at it from this corner, where you have the limit is 4,000, and you
Yes. See, these sections are discretional. Yes. The max is 20 max. And we are going to get like, let's say, 15, 12 there. It's okay. Yes. So don't worry about this section. This section is for those who want to score our best, especially this particular section. Good. Now you have two options. This 4,000 is too much. Option number one, you can use it. The answer will still be the same to balance nicely for you. Or you can tell us that okay, this 4,000 is too much. So I will convert part to be a long-term liability and part to be overdraft. So that I will have little item here. So that my working capital will be also small. How do you get it? Good. All of them are what? Discretional. If you like, you can use the full amount like this. Good. So let's use the full amount, right? Or let's convert part.
just you just
Okay. So if I'm using the full amount, the only current liability is 4,000. And now we have assumed that the current ratio must be what? 2:1. It means that for every one current liability, there must be how many current assets? Two. For every one current liability, there must be what? Two current assets. So if my current liability is 4,000, what will be my current asset? 8,000. So here the total current asset must be 8,000. So tell the examiner that total into bracket 2 times what? 4,000. So that means my total current asset must be 8,000 because the current ratio is 2 is to what? 1. You can also select 1:1. Current ratio must be 1:1. That means my current liability, the total must be the same as what? My total asset. So here, that one it is to be what? 4,000. So for every one Ghana cedi current liability, there must be one Ghana cedi current asset. Discretional. Choose the one that will help you finish the question fast. That is it. So here we are selected 2:1. That will be 8,000. So that will be 8,000. Okay. Okay. Now with this one too, you can still tell the examiner you can make a division. I may make changes here, so don't need to worry at all. I may make changes here. You can convert some of the overdraft 4 million to be what? Non-current liability. Because if it's too much like this 8,000, that means this figure will be too much, right? Yeah. Yes. 5,320. Perfect. So if you do this here, then that means the balancing figure here must be 5,320. The balance, you add all this, subtract from the 8,000, then you are done. Good. So that is it. Okay. So great. So in short, when you substitute this figure in there, it's more than the 8,900. So what do we do? So that this overdraft must be reduced, or we have to ask any of the shareholders to bring additional money. Yes, we have to increase this, or the preference shareholders they should give us 2,500. That one you can still maintain it like this. Yes. because they have to pay. We have to find someone to bill them for them to make those payments. Or we have to first reduce the overdraft, because overdraft of 4,000 is more than the loan. So part must be converted. You can share. 2,000 must be converted. 2,000 will be bank overdraft. Agreed. So discretionary. So the 4,000 part must be converted, part must be remain. So convert part to long-term liability. Yes, or hardcore overdraft, right? When hard overdraft stay long, can convert to what? Loan. So let's convert some of this overdraft to what? A long-term liability. So out of the 4,000, discretionary, the part that you want to convert is discretionary. Take note that that part is what? Discretionary. So me, I want to do chimpe, right? 50-50. So I'll convert 2,000 to be a long-term liability. And I'll convert what? Then I'll maintain the 2,000 as what? Bank overdraft. So in my new financial position, the balance sheet, the bank overdraft must be what? Must be 2,000. Agreed. Perfect. So I'll put 2,000 here because I've done the conversion. And immediately I'll tell the examiner that I've selected a ratio of what? 2:1. So that means if my current liability is 2,000, my current asset must be what? 4,000. 2:1 means for every one current liability, there must be two current assets. So 2 by what? 2,000 will give me 4,000. So that's my total current asset. Then I'll balance it. If that's not balance, the difference is my working capital requirement. Is the balancing figure. So the working capital requirement will be the balancing figure. Agreed. Okay. So friends online, kindly, perfect. So balancing figure, that's the working capital requirement. Just a balancing figure. Working capital requirement. In fact, it's a cash bracket, the balancing figure. 1,320, right? Agreed. So if it's 1,320, then come straightforward. Come and put it here. As your working capital requirement, 1,320. That's the workings. So all this offering is about what? Working capital requirement, that 320. Don't forget that in your new financial position, the bank order is what? 2,000. And then there's a non-current liability of what? 2,000. That's all.
Because they're giving us the limits of the overdraft at 4,000. We've used 2,100. So we are using the difference of the 1,900. So we are going for another one.
Perfect. Now, if you add all, it's not equal to 8,900. The difference must be the asset that you are going to buy. You have to buy that asset. So the difference must be the plant that we have to buy. And that will be, so in the new financial position, the working capital here must be the cash. In the new balance sheet, it will be the cash balance. It will be the cash balance. Then what's the figure here? The balancing figure. Good. So 3,900. That's all. We are done. It is discretionary. You can make a changes here, but to be on safer side, please don't even, if they don't give you the ratio, just put any figure there. You are right.
So can we assume that you will work and then you balance, but there will not be the need for you?
Exactly. If you work and it's balanced, there's no need for you to buy plants. If you want them to buy the plant, then look for one of these guys to be billed or to pay for that money. Preference shareholders, they should top up. Give us 2,500. But their value should not be more than 3,000. Yes, other than that, be some way. That is. So we are done. And that's the terrible stage. Once you are done with this, the rest is empty. We are going to write a scheme. So let's see how we write a scheme. Please, writing the scheme. It's just like short sentences that are going to give it to us. Short sentences. Once this one balance, that means your financial position will balance. If this does not balance, your financial position will never balance. Take note. Once you have 8,900 balance, you are done. Okay, so let's go ahead and write the scheme. Right after the scheme, the financial position, then we are done. How do you write a scheme? This is how you write a scheme. We are going to use this information, so I'll not claim this information because that's what we are going to use to write a scheme. We are going to use the information here to write a scheme. So I'm not going to claim it. So I'll rather write on top. So I'll go to top, go. Perfect. So I'm on top. After the scheme here, so that's the step number 5. This is step 3, step 4, step 5. Then you tell the examiner, proposed scheme. So proposed scheme. Analyze it.
So you use the shall, the multiple lot, and then the result will come.
Yes. The scheme writing, these 2 items that we need first, then you fall on the other items. Now you write all the persons one after the other. So number 1 on the list, or A, you talk about each of the person here, the key stakeholders, ordinary shareholders, preference shareholders, that of the debenture holders, accounts payable, accruals, and the bank overdraft up to the very last one. You know that I've cleaned some portion from here, right? So we have to talk about everybody. Now I'll start. I'll do one, you do one, and that's all. Then we are done. Then you tell the examiner. First on the list is ordinary shareholders, all right? Ordinary shareholders. Let's write it like this and align it. Then come and write. Now the sentence must be brief. It must contain 2 items. Only 2. What they must lose, and then that's all. So what you have to sacrifice, and then what you have to bring, that's all. What you are going to lose, and then what you have to bring, that's all. So 2 items. That sentence, the first part must tell us how much they would have to sacrifice, and then how much they are bringing. So now shareholders, how much are they losing? This is what they are losing, right? How much are they bringing? So let's go to the money. How much are they bringing? Ordinary shareholders, they are bringing 3 million, but they are losing this. That's all. But if you look at this, that is their capital investment. So it means that they are losing everything, and they are bringing what? 3 million. How we get it? So that's the first point. Ordinary shareholders are losing all their investment, which is the 5730. Good. Please avoid most of the figures. Yes. No. But there are 2 different items. They are losing this. They are bringing this. So that's the statement they are going to tell us. So that will be the proposed scheme. So I write it nicely here. Then you look at it and then you write your own 2 for me. Then I'll take it. So first, let's start the examiners. Let's go to the top there. So I write it there nicely. So right after the ordinary shareholders, I write the ordinary shareholders. I will take off this part this section from there. So if you have not copied, kindly take note. I'll take off this section from there. So that's alright nicely. So I'll start from there. The ordinary shareholders, no shortcut to the report. Shareholders must waive of all their existing investments. Have you seen? I'm avoiding figures because I don't want to submit myself. Because I'm going to say 573. No, this one is million. If you want to write it, you can go ahead and say existing investment of 5.73 million. Do you write 5,073, you are wrong. You are submitting yourself to avoid the figures. Avoid most of the figures. Yes. So they should lose all the existing investments and subscribe and then subscribe to a new shares, new what shares. So I can take ordinary share there. Subscribe to new shares amounting to that's the 3 million. That one right at 3 million. Amounting to Ghana City of what 3 million payable by cash immediately. Those terms are not necessary. What they must lose and what like they have to bring. That's all. Two items. So ordinary shareholders must waive off all their existing investment and subscribe to new shares amounting to 3 million. Full stop. You are done. Now if I do one, you do one. So you are going to tell me more about the preference shareholders, what they must lose, what they must bring. Good. So then we are done.
The preference.
Yes. Perfect. So we talk about ordinary shareholders. Let's go to preference shareholders. Number two, we are going to the preference shareholders. Now the preference shareholders, they are losing this, all their existing investments, and they are bringing how much?
2 million.
Yes, preference shareholders, they are bringing 2 million. Agreed. Perfect. So they are bringing this 2 million. So preference shareholders are bringing 2 million. So one, they are losing all their existing investment and they should bring 2 million. That's one. Plus the dividend in arrears,
Should be written off.
they are losing that one too. Okay. So that one you can put all of them in one sentence. That both the existing investment and the preferred dividend arrears must be what? Written off and subscribe for new shares amounting to 2 million payable by cash or just 2 million and then good. So that is it. So I'm going to write that one. So let me clean this. Or in fact, let me clean all these ones from here. Because you do have them there, so that I can write them nicely. You have everything there. You do have everything there. So let's continue the game. So the next person on the list will be B. All right, here preference shareholders. Shareholders. I want to line it and talk about them. Number one, I said that the preference shareholders must cancel both their existing investments and the preference dividend in arrears. preferred dividend in arrears, and subscribe to a new shares amounting to 2 million Ghana cedis. Full stop. I don't want trouble. So that is it. Have you seen it? So do it line by line. All the key stakeholders, please talk about them. Avoid mentioning too many figures because it may land us in trouble. Good. Then I'll go to C. The next one, who. So the next one, I will just detect them. The next one will be debenture holders, right? So 20% debenture holders. So 20% debenture. Right here, 20% debenture. So what are you going to talk about them? Or just debenture holders? So 20% debenture holders. Debenture holders. You analyze it, and you start writing. How much are they losing? How much are they? They are losing nothing, right? Debenture holders, according to the share of maximum loss, we give them nothing. Perfect. How much are they bringing? So debenture holders, they are not losing anything, right? So what are you going to tell them? We can also tell them that they are not losing anything, though. Like we can't state it like that. So is it secured? Is it secured as a fixed charge? So let's check the debenture holders. Let's check the debenture holders. Good. Let's check the debenture holders. It was secured on what? Freehold property, right? So them, they are not losing anything. Them two, they are not bringing anything, right? So let's say that in any business, we are going to still secure the loan on what? That debenture on what? The freehold property. For some time, they may, the fear is that after the reconstruction, you may tell them that we are not going to secure it again on the freehold property. They'll get annoyed. Good. So first, debenture holders, just tell them that uh, the debenture, 20% debentures will be secured on what? The freehold properties. But you can't tell us that they are losing something. They're not bringing anything to. We have to write something about them. So it must be secured on what? The freehold property. You are done. So you start. 20% debenture, 20% debentures will be secured on the freehold property. We are done. The next person on the list. So you talk about the share of maximum loss. You pick it from there. Who's the next person after the debenture holders? Accounts payable, right? Okay. Now, accounts payable. That means for them, how much are they losing? How much are we paying them? So I'll start with accounts payable. So let me write accounts payable here. Then we continue the game. Let me write accounts payable here. Then let me continue the game. So I want to clean the ordinary shareholders so that I'll bring accounts payable there. At least write about 7. Minimum of 7 notes. Maximum of 10 notes. Write about 7 notes. So as we are writing like this, 1, 2, 3. So we're on the 4th one, right? So I'll go to the 4th one. So right here, accounts payable. Underline it. So tell us that how much are they losing? Accounts payable, how much are they losing? They are losing 126,000, right? Yes. Account payable, they are losing 126,000 cedis. So tell them that first.
What was the 126?
Good. So 126,000 of the account payable, account payable must be cancelled. Must be what? Cancelled. Must be cancelled with the remaining balance being paid immediately. Remaining balance being paid immediately. Full stop. Remaining balance being paid what? Immediately. So that's it. Because you paid the accounts payable. We cancelled 126,000 and we pay the remaining balance immediately. So the same thing will apply for accruals. The same story will go to accruals. Accruals 2, 24,000 must be cancelled with the remaining balance being paid what? Immediately. So accruals 2, the same show. So then we go to the fifth one. Have you seen there's reconstruction expenses here, right? Which is what? 30. So write it. Reconstruction expenses will be what? Will amount to 30,000 cedis. Just recopy from the question. Reconstruction expenses will amount to 30 Ghana cedis. But the 30 Ghana cedis not coming. 30 Ghana cedis. Put it there. Let your currency be on the same value. So I'm using this one, GHC, it should be on the same value. Not like this. Full stop. Then F, the bank overdraft, right? Thank you. So bank overdraft. So let's go to the bank overdraft. The bank overdraft. Let's go to the bank overdraft. Then we are so bank overdraft. So F is a bank overdraft. The rest I'll detect them. Bank overdraft. Now what are you going to say about the bank overdraft? Okay, we have a lot to say about the bank overdraft. Good. So first, we are taking additional 1,000 what? 1,900.
Taking 1,900 to exhaust our limit.
Good.
Then we take additional, we took how much?
Then we convert 50% of the total bank overdraft to what? Non-current liabilities. Maybe 10% loan note. We are done.
We said that the current liability, we're going to
Perfect.
4,000.
Okay.
And we're going to share it 50-50.
Okay. So perfect. So let me clean this section and then bring that one there to end the game successfully. To end the game successfully. Great. So to end the game successfully. So I'll still bring it here, bank overdraft. Let me continue here. F. Bank overdraft. Now what do? Tell the examiner that first, there are three things here. One, you have secured additional overdraft of 1,009, which has moved them to what? 4,000. And then, which is the limit? Then convert 50% of this amount to what? A 10% loan note. Yes, 10% loan note or just loan note, long-term liability. Just create any loan note at all of your choice. 20% loan note, 15% debentures. That's all. Create any loan, any long-term liability of your choice.
The OD was, the limit was.
So first, with the overdraft, all what you have to tell them is this. First, we went for 1,900 additional. Second, we have converted what 2 million towards non-current liability and create your own non-current liability. Tell them that 10% loan note because you've been solving final account question, you've been meeting 10% loan note, 20% loan note. So any of them create it. Let there be percentage because to entice them, there must be interest. The reason why they are converting the overdraft to be a loan so that they can also enjoy what interest on the overdraft. Good. So let's put it down. So additional 1.9 million to this must be given additional 1.9 million to this of the bank overdraft must be given. Let's put of the bank overdraft here. Of the OD must be given to us. So let me of the OD, please write to full bank overdraft must be given and 2,000. So and just make things look easier. And 2 million. We talk about accrual, so we can claim this section from there. Where we talk about accrual. Those that have not claimed, that means not talk about them. Those that have not claimed, meaning that we not talk about them. Okay. So additional 1.9 million of the overdraft must be given by the bank, and 2 million will be converted into 10% loan notes or 10% loan. We are done. So that's all for that of the bank overdraft. Then G, the next item, talk about the working capital requirement. Talk about the working capital requirement. So tell the examiner that scheme, this scheme will achieve a prudent working capital ratio of or a prudence current ratio of 2:1. Go to H. You are talking about everything. We've talked about ordinary shareholders. Let's go down. Let's go to the resource requirement. What we've not talked about. Let's go to the. We've not talked about
Plants.
plants. So they should buy new plants. So that one plants. Plants. So they should buy new plants amounting to 3.9 million. New plant costing 3.9 million must be acquired for production purposes. For what? Production purpose. Tell the examiner that is for production purposes. We are done. Then I. Please don't need to write plenty. Maximum of 7. Like minimum of 7, maximum of 10. You don't try plenty. Okay, you can do selection. If not talk about the development expenditure, it must be disposed of. Deferred development expenditure must be disposed of. That note is in the question, so you just copy that one and then you add that. Just copy that question and then that's all. income surplus must be written off. Income surplus must be written off.
If there is capital surplus, we write it.
You write it off. So that it's part of the
Then
the
valuation
it's
surplus.
part of the proposed scheme. Part of the
Valuation
scheme.
surplus, we write it off.
Yes. Preparation surplus written off. Income surplus should be written off. Then you go to the assets. The asset must be stated at the what? Their liquidated values. That's a non-current asset and a current asset. It must be stated at what? Their liquidated values.
I'm confused. I thought we said for the we take the fair value for reconstruction. This is the proposed thing for this one.
Good. Now,
Now using the liquidated value.
good. In reconstruction, we need the fair value. But for this particular question, we selected liquidated values as the fair values.
Oh, okay, so if
The fair value wasn't given to us, so we use the liquidated values as fair values.
okay, so that means that if there was fair value, it could have
Thank you.
assets should be stated as that.
Uh-huh. So now the issue is this.
So what if you decide to dash right and it should be stated as going concern? Is it also fine?
That's so you can tell the examiner that the assets will be stated at their what? Their going concern values. You are done. It will be stated at what? Their going concern value. So it's like a referral. So one, either write the assets will be stated at their what? Going concern value, or their liquidated values. You are fine. Have it. Then the last note must be like this. Your last sentence. Your last sentence must be like this. This scheme holds a promise of future profit. That's your last sentence. Let me take it again. This scheme holds a promise of future profit. And then you are done. This scheme holds what?
A promise of future profit.
That's all. That means when they accept this scheme, in future they'll make profit. Put it there. And then that's the end of the game. Then the last aspect, then we say bye-bye to this section. We call it resultant statement of financial position. It's a bit straightforward, and then all the figures that will go in there, you have it already. So that one, don't score any points or don't leave any point for the examiner. Then you are done. Good. So the resultant statement of financial position, please, here, just follow them. When they move, you move. When they stop, you stop. That's all. When they move, you move. When they stop, you stop. So you have to go to their financial position. When they move, you move. When they stop, you stop. Then we are done. So their financial position, let's go there quickly. So you start your financial position like this. First, freehold property. Pick the going concern values. All the assets, pick the going concern values. So that is it. And it will be a trial work for you. And then you balance it off nicely. If it has not balance, first balance and then forward it to the mail. So going concern values, when they move, you move. When they stop, you stop. So all the going concern values. So you write freehold property. I'll go and pick the going concern value. I'll go to plant, machinery, and motor vehicle, going concern value. I'll go to deferred development expenditure. Now it has been disposed of, right? So it's not coming. So take note that it has been disposed of. We sold this. So don't bring it again. Don't go and pick the going concern value of this because it has been disposed of. Then instead, write a new plant. So write a new what? Plant. How much the new plant? 3,900. So you bring new plant, 3,900. You put that one in. You sum it up. You push the answer here. Then you go to current asset. Inventory. Take the going concern value, which is still the same as 2020. Then account receivable. Pick the going concern value, which is what? 660. Then write here cash. The next line right here, what? Cash. The cash is the working capital requirement. What do you get? 1320. You put it there. I repeat. Here you write, you include cash. That is the working capital requirement. You put what? 1320 as the cash. If this question they already have cash, add it to it. You are done. If there's cash in here, add it.
To the working balance.
The working capital requirement. Good. So our next question that we'll pick, it will involve that there will be cash there for you to see how we are going to work with it if there's cash there. Then you are done with your total assets. Then you shift it here to get the total assets. When they move, you move. When they stop, you stop. You go to current liabilities. Over there, it will be only one bank overdraft, which will be what? 2 million or 2,000. But it was 4,000. We've converted 2,000 to be what? Non-current liability. So left with what? Just 2,000. So put the 2,000 here. That's all. Not no accruals, no prepayment, no account payable. We've paid all of them. So yes. Then move on. Then they had net current liabilities. They put all the non-current liabilities together. They subtracted from where the current assets, and they had the net current liability of what? Of this. But you get a different answer. Then you go to non-current liabilities. 20% debenture, it will come 3,800, will not change. Then 10% loan note, 2,000. The part of the overdraft that you've converted to be a loan note, it's a non-current liability, which will come here as what? So when you go to non-current liability, in the new balance sheet to be 2. The existing 20% debenture was 3,800 plus 2,000. The old that we converted to be what? The loan. You put the 2,000 there. It must balance nicely. Then you add the two together. Then when they add, you add. When they subtract, you subtract. Follow their footsteps. Or you can also follow, if you know our own format, use your own format. Which format? The format that we know already, you can use that one. All assets one side, which is equal to equity plus what? Liabilities, right? Equity plus liabilities. If you know this, you can use this one and then you move on. But sometimes, if you have no idea or you forget about the format, then follow the format there. If you remember this, all assets, the total assets method. Note that the balance sheet presentation, there are two. We have the total asset and what? Net asset. What they've done here is the net asset, but you can still go by the total asset. It's also correct. Good. So take note of that. Then we are done. So now let's move on. Then the last section is the stated capital. When you get there, you said that they are losing everything, right? So you start with the ordinary share capital. Ordinary share, how much are they bringing? 3 million. Preference share, how much are they bringing? 2. So you write ordinary share capital, 3 million. Preference shares, 2. So it will be what? 5 million. If you put all of them together, no income surplus, it has been written off. No income surplus, it has been written off. If you put all of them together, you get the answer. Then you are what? Done. Perfect. And that's the end of today's section. So kindly try it and let me have the solution and then let's balance and then you are done. Great. So unfortunately for us, this is how far the good Lord will bring us. On that note, we will continue again. That's the end of capital reduction. Now, next meeting, we are doing revision. We are solving last certain question. Yes. Great.